Welcome to the Chartered Financial Analyst Level 1 video series. As usual, I provide a small introductory slide about my qualification and experience. Today we'll continue the topic of corporate finance and equity, and this is video number 10 on cost of capital. We started the topic of cost of capital last video, the video number 9. Today we'll continue with the topic of capital structure as it relates to the cost of capital. How is that? The capital structure does affect the cost of capital, because if we have more debt on the capital structure, then we would expect a lower cost of capital than if we will have a huge equity finance company. So the capital structure means how the company is financed. Does the company have more debt or less debt? This is how we look at capital structure. If it has more debt, then we will expect the cost of capital to be lower, because cost of debt is cheaper than the cost of equity for a reason we discussed earlier. So let us see how the capital structure affect the cost of capital. As I just mentioned, there are two types of finance that the company can get. The first is from the equity, which is the owner of the company, that is the shareholders, while the other from the debt holders. So we have two types of capital. One is equity, the other is debt. Fund provided to the company is expected to be invested at a return higher than the cost of capital. In such case, the company will create value to the fund provider, whether these are equity or debt holders. Definitely, if the cash flows are riskier and uncertain, then the cost of capital will be very high. So the classical relationship between risk and reward, the higher the risk, the higher the reward requested by the owner of the company. So the cost of capital of a company is the required rate of return by the investors. What do we mean by the investor? Investors are the shareholders and the debt holders. These are the shareholders. So they will require rate of return is the average risk of the investment in the company. This is why I keep saying that the higher the company risk, the lower the value of that company. So managers should act diligently to reduce the risk so that the cost for their capital will be very low. Also, there is the issue of the tax. The weighted average cost of capital formula also is affected by the tax rate. If the tax rate is 40%, then that will provide a good shield for the profit from the tax. And this is why we say that always that the tax deductibility, that is the interest deductible by the tax authority for interest paid on the debt, makes the debt cheaper than the equity, because dividend paid to the shareholders are not tax deductible. So the deductibility makes the marginal cost of debt cheaper. What do we mean by marginal cost of debt? If the cost of debt is 5%, by multiplying 1 minus tax, then we will get lower cost. Let us assume that the debt holder required rate of return is 5% times whatever here. Let us assume we get 0.7. 0.7 into 0.6, then you will get lower than the 7% cost of debt. So debt in the capital structure of the company makes the weighted average cost of capital cheaper, because of this fraction, which is not in this portion relating to the equity. Let us take an example of a company, call it ABC. It has a capital structure of 3 types of finance. The first is debt, and then the preferred stock, and the third one is equity. Each has a percentage. So the equity is the highest weight. It has 60% of the total finance, while debt is 30% of total finance, and preferred stock is 10% of the fairest of the whole finance provided to the company. These are the debt weight. These are the finance weight, whether from debt or equity or preferred stock. Each has a required rate of return. The debt cost of debt is 8%. The cost of preferred stock is 10%, while equity normally is the highest because these are the riskiest investment, as shareholders are the last to be paid in case of bankruptcy. This is why equity is not protected. They bear very huge risk compared to debt holder. Debt holder always get paid first before the equity, while the preferred stock is in between the 3. As you can see, this is the cheapest because the safest, a little bit riskier, 10%, and this is the riskiest investor, 15%. So the tax is 40%. Let us see how do we calculate the weighted average cost of capital based on the formula. It is basically the weight times the cost of each item. We will start with the debt. The debt is 30% times its cost, 8%, times 1 minus tax, 8% times 30%, times 1 minus tax, which is 40%. So this will be very cheap. 8 times 3 will be 0.24. 0.24 times whatever we get here, 6, it will be even cheaper. Let us add also the preferred stock plus the preferred stock. The weight is 10%, times the cost of the preferred stock. 10 times 10 for preferred stock. 10 times 10. Let us also add the equity, which is at the weight of 60% times its cost 15% will give us the equity. 60% times 15%. So the weighted average cost of capital of the 3 sources of fund will equal 11.44%. This is how we calculate the cost of capital, taking into consideration the capital structure. Here we have 3 sources of finance in the capital structure, with the with the equity having the highest weight, and then the debt. Let us move on and explain what we mean by capital structure. I just mentioned that it refers to how much debt we have relative to equity. That is, debt divided equity will give the capital structure percentage, 30 to 40, 30 to 70, 50 to 50, and so forth. Normally, companies aim at certain level of a capital structure. It has a target. Normally, it will be between 30%, 40%, 50%. They will say, we will have a debt to equity ratio of 40%, for example. That means 40% of the finance is provided by the debt, while 60% is provided by the equity. So debt divided equity, it has certain target. Definitely, as the company moves in the business, this target will keep changing, and manager will again take necessary decision to bring the structure within the target they are looking for. Normally, we should use the target capital structure if it is known to us. If it is not known, we estimate it. How we estimate the capital structure? If we don't know management targets or the company's targets, we use either we assume company's current capital structure today, how much it is. We use it, or we will look at other companies also or competitors. Examine trends in the company structure, statement of management regarding capital structure. Normally, management makes several disclosures. They make comments in the quarterly earning review. They will mention that we maintain between 40 to 50% capital structure. This is one way of finding it. Use the average of comparable companies' capital structure. That is, we use the companies in the same industry as a proxy for the level of debt, relative debt to equity, which we call it leverage, which represent the capital structure. Let us have another example. Sorry. John is a financial analyst with a company called ABC. ABC is in the process of estimating the cost of capital of XYZ. The following information is provided. Now we need to see what is the capital structure of XYZ. What percentage of debt to equity we should use. The current company market value of debt is 50 and equity 60. Let us not forget that. Debt is 50 million and equity is 6 million. We need this figure in the following slides. And competitors have the following structure. Let us see the competitor, what they have. Competitor first, market value of debt and market value of equity. These are the three competitors the company have. We can use either of them to estimate the capital structure for our company. What are XYZ proportion of debt and equity that John would use if estimating this proportion using company's first one, current capital structure. As I just mentioned in the previous slide, the current capital structure is 50-60. So the second question, if we are going to use the competitors' structure, or if the company announces that debt of the equity should be 70%, that is 0.7, which reflects its target capital structure. So we have three ways to estimate. Either we use the target structure, capital structure, or competitors' capital structure, or the existing capital structure of 60 and 50. Let us see how we are going to do this in the next calculation. Okay, if we want to use the capital structure, the current situation, which is 50 and 60, we do it this way. The weight of the debt equal the value of the debt plus 50 and 60, the total finance. This is how we get it. And we take the weight of the equity also, which is 60 equity, divide the total finance, we get this. So this is the capital structure, 45%, 0.45, 54.54% equity. If we are going to use the capital structure of the competitor, let us bring the competitors again here, A, B, C. For A, we take 25 debt, divide 50 plus 25. This is the total finance we have. Market value of equity and debt. That is debt and equity. This is the total finance. In the denominator. In the numerator up, we put the debt so that we get the percentage of the debt. 25 divide 50 plus 25. 25 divide 50 plus 25. Here also 101 divide 190 plus 101. 101 divide. Here also the same. And then we take the average of the 3. Divide 3. All this calculation divide 3 will get this one. So definitely the weight of equity will be the other way around, or we could simply say 1 minus this one will give this. So in the case of equity, we take 50 equity divide both finance, 190 divide both finance, and so forth. And don't forget always to divide by the 3 companies to get the average. So the total of this should always be 1. The third way The first one, the capital structure. The second one is using the competitor capital structure. The third one, as I said, is the target announced by the company, which is 0.7. If the debt is 27, debt to equity 70%, then to get it, you have to divide this by 1 plus 7, because 1 is both debt and equity. You get this, and then the weight of the equity is just 1 minus this one, and you get this. So this is how we can use the debt weight or the debt percentage, that is the capital structure of the company, using these three methods. With this, we come to the end of video number 10. Please do subscribe. In the next video, we will continue with the same topic. Thank you.